All right, guys. So I think we should start. So first of all, I am delighted to welcome you all at the webinar that was prepared in cooperation with CoinScrum, and hope you've all survived the roller coaster ride during the last several days with all the drops and raises of the crypto prices. But here you are today. And today we have brilliant speakers, which I'm going to introduce in a couple more minutes. We'll be talking about the digital assets trading and issues related to that. So we'll touch on the trading venues and where this trading actually happens. We'll talk about the bet behavior, and we will talk about the price discovery and why is that important for all of those who are interested in getting to know the crypto market, the trading activity, and everything that is related to that. So our goal for all the speakers today for this webinar is just to help you as investors, as traders, to save your money, basically, on choosing the proper execution options. And I'm sure that will be, quite helpful for all of you here with us. So I'm going to end the poll and make the introduction of our speakers so you can clearly see them. So just for the recording, so right now we do have almost 30 people participated in the poll, and we have a pretty interesting split. So our audience is pretty diversified. So we do have some people that don't have any experience in trading, to those who have some minor experience plus medium, and the professional level as well. So that's going to be interesting. I will briefly share the results, and here you see that. Then let's start the discussion. So first of all, I'm glad to introduce you Nick Hammer, who has began his financial career in 2001, and during the 20 years had various positions with equities, fixed income futures, and FX trading. Have experience at launching several businesses that serve wide range of clients. And right now, Nick is acting as the CEO and one of the co-founders of the Blockfills. So Nick, please. I think you're muted.
It's not a real Zoom webinar if someone is not muted at some point.
The funny thing is that we've gonna do all the preparations and testing. So so I think what we can do that is that I can introduce Michael, and then I'll just pass the word back to you, Nick. So we also have here today on the webinar Michael Rabkin. He is the head of institutional sales and head of global partnership at DiviChain. Before that, Michael was the president and founder of Sigwan Capital, an institutional OTC digital asset trading platform, which was basically acquired by DiviChain. So Michael, please say hi to the audience, and let's test your microphone.
Testing. I
All
think
right.
everybody can hear now. Perfect. So thank you, Konstantin, for the introduction, and thank you, Konstantin and Paul, for putting together this webinar. So essentially, DiviChain, what we do is we provide market-making services to institutional clients and exchanges. We allow them to trade a broad range of cryptocurrencies through a variety of APIs and interfaces. So essentially, clients can seamlessly settle transactions in multiple fiat currencies on the same day. We also provide other professional services related to trading. We are an affiliate, so DiviChain is an affiliate of Divi Trading, which is a Chicago-based proprietary trading firm. We're also an affiliate of Independent Trading Group, a Canadian broker-dealer, and the Canadian Investor, which is part of the Canadian Investor Protection Fund, the Toronto Stock Exchange, and the Canadian Securities Exchange. So just high level, Divi knows the mechanics and plumbing of both the traditional securities market and the opaque, less understood Bitcoin market to create solutions that help both the market maker experience less slippage and products in the market experience less trading slippage as well. So ultimately leading to a much better investment for anybody that comes to us. And sorry for that selfless pitch, but I'll end it there.
All right, perfect, Michael. Thank you, Nick. Do you have tested the mic? No.
We can try to read Nick's lips.
No, we can't hear you.
All right, so maybe you can just try to reconnect and test the mic. But let's let then switch to Chen. So our next panelist, Chen Arad, is the Chief Operating Officer at Solidus Labs, which Citigroup recently listed as category definer for crypto market surveillance. And Chen basically has like a huge experience in the crypto related and regulatory practices. So I think, Chen, you can make introduction and talk a little bit what Solidus Labs does. And we also congratulate you with the round of financing which you just raised, which was in all the news across the last couple of days.
Thank you. I can definitely say that my hairline was a little longer before the last few months, but no, thank you. I really appreciate it. And I guess similarly to you guys, Michael, we our team was founded by mostly former Goldman Sachs fintech engineers. I'm the exception on our leadership. I used to be a journalist, but really people who understand trading, the technology behind trading securities, and also had to deal with some of the regulatory adaptations following 2008 and the Dodd-Frank Act. Basically, we looked at the crypto space. Needless to say, there's a plethora of new opportunities here, but it also introduces many new risks to do with the new underlying technology, the way trading works. It was clear to us there's going to be a need for tailored risk monitoring solution. That's what Solidus provides. We offer a comprehensive, automated and testable unified risk monitoring and market surveillance hub. In practice, we help detect, investigate, monitor for, and ideally prevent in the first place in real time market manipulation and other forms of risk. We work, with some of the biggest exchanges in the space, brokerages, increasingly with DeFi-oriented use cases, and also with regulators. And I'll stop there, but look forward to this conversation.
Thanks, Chen. So just once again, for all the attendees here, I'll raise the point that all the market, manipulation practices that happens in the crypto space, they came from the traditional markets, and that's why it's really important for all the market professionals, which I am, delighted to be across them here today at the webinar. So it's great that we have that experience here in the digital asset space.
What's interesting, of course, is that crypto also introduces many new ones, but we can get to that later, in addition to the ones we know from traditional markets. But yes, we'll get to that later.
That is for sure. All right, so let's try to give it one more try to Nick Hammer, CEO of the Blockfills. Nick, you're with us?
There you are.
All right. Sorry about that, everybody. Had some speaker issues here. So my name is Nick Hammer, CEO and co-founder of Blockfills. We started off in the crypto markets in about 2017, and my background's in more so traditional financial markets, both on the technology, algorithmic trading side, and really operating different brokerages in both the foreign exchange and derivative space, particularly commodities. We got involved in the cryptocurrency markets in 2017 because we felt that things were a bit too fragmented across the globe between exchanges, and we wanted to provide, really a more liquid and efficient marketplace for institutions or professional traders to trade. So that's why we originally started Blockfills. Over the course of the last couple of years, we've increased our product and tech verticals into a number of different areas, but primarily we provide execution and liquidity through an electronic communication network via API, and or trading GUI to professional clients across the globe in really both the spot and derivative markets.
All right. Great, guys. So that's for the introduction. So let me also introduce myself. I'll be moderating today's panel. My name is Konstantin Shulga. I'm actually quite new into the blockchain and crypto space. I've joined Finery Markets as the CEO just a couple of months ago. Before that, I've spent 12 years of my professional career within the traditional asset space at the various positions at the largest Russian and global banks, the Moscow Exchange. And the last 5 years, I was managing the brokerage arm of Sberbank, the largest Russian bank. So right now at the Finery Markets, what we do is we are actually aggregating all the major liquidity providers to provide our institutional clients with the best execution options possible. And we're also delighted to have Blockfills at DiviChain as one of our key liquidity providers here. So let's start the discussion. And in order to set the tone, I would like to start with a brief presentation that will basically share some insights and some statistics with you. So I would like to start with mentioning some of the numbers for the trading. So actually right now, the volumes in the crypto asset space, they're growing. The volatility is at like almost historic heights. According to the Block Crypto, in the 24 days of May, the average daily volume traded at crypto was almost $80 billion, which is, a huge market. But what's the most important about that is that where that all was traded. I mean, the venues where this liquidity is, is coming from, and where all the volumes are from, they're spread across over 300 centralized public exchanges, which makes crypto assets, I would say, maybe the most fragmented asset class in the history of capital markets. And this really provides us with, lots of opportunities on the one side and lots of risks and issues on the other side. And we will talk a little bit about that in the future. Plus, there are almost or over 100 OTC desks and liquidity providers who are trying to source liquidity across different sources, that all in common, combined with the trading at the public exchanges, makes the fragmentation sometimes more, sometimes the OTC desks are trying to bring up the best liquidity possible for the major exchanges. And one of the first questions I would like to address is what's the real portion of it is the real liquidity versus the volume? Because right now the chances of having one buyer of one Bitcoin and the seller of one Bitcoin to be matched at the same venue are extremely low. And that leaves us with the question, what's the real liquidity here? What's the proportion about the volumes in the market reported here and the liquidity? And I would like to start with passing the word to Nick. So Nick, what's your estimation? What are the real flows here?
Well, for me, it's a difficult question to answer. I believe that the reported, if you look at it from an exchange perspective, just because they're so fragmented, and inconsistent from a regulatory perspective and country to country, and I believe that the lack of, there is a lack of transparency there. So I believe that the reported liquidity versus the real liquidity is probably, much higher, probably based on what I see, 4 to 5 times higher than what's really out there. And that's really for a myriad of reasons. But I think that it's really tough to know, because if you go to any sort of data sources, if that's Crypto Compare or Mizari or CoinGecko, CoinMarketCap, all the data is different across all of those data sort of providers as well. So, and all of them have different metrics on how they calculate and how they benchmark real liquidity. So if you look at that from that perspective, I think that what really is out there versus reported from an exchange perspective, what's reported is much higher. I also think that there's a lot of wash trading that may go on, especially at the second, third, fourth, fifth tier exchanges, especially as you get into more third world countries where these exchanges are operating. A lot of them use different robots to generate volume.
Let me clarify. So you said like 1/5 of the total volume you think like maybe the real liquidity, right? And
that's right.
80%. All right. And like I think we should also split the terms, like the fake volume and the real liquidity. So do you think that's a big difference between those two, and how does that affect the end client, like those who listen to us right now?
I'm sorry, could you repeat the last part of that?
I mean, and how does that fake volumes, like the 80%, how does these numbers affect those who listen to us and those who want to trade the crypto markets?
Yeah, well, I don't know that it necessarily affects them, every second of every day, because there's still plenty of liquidity in the major coins. I think depending on what exchanges that you're trading on. I think that there's another way to look at the real versus reported volume, and if you look at companies like a Blockfills or maybe even a DV chain, and I'm not sure on DV chain, but there's a lot of liquidity providers that provide a lot of liquidity in the space that don't report anything, and that's starting to change. But there's a lot of liquidity out there in the DeFi space. We do a lot of trades every day off exchange, so that all factors into this whole thing too. I think it's just too difficult to really come to a conclusion. But I think if we're just focused on exchanges, I definitely think that the real volume is much lower than what's reported, and that can affect the trader adversely, especially when they're trading in size, and also depending on what strategy they're using, because if they're just running robots that are buying and selling and liquidity is not really there, or if there's just a lot of top of book liquidity and nothing behind it, then they're getting a worse trading experience, more slippage, worse spreads, poor execution, et cetera, et cetera. And I think I'd like to also, comment that, and I'll stop here, that I think that it's even more difficult to address this issue when we get into altcoins versus the sort of the major coins.
If it's okay, Konstantin, I'm happy to jump in here for a second. And first off, I'll say, my firm specializes in understanding the health of volume. That's what detecting market manipulation is. So we think about this all day. And the first thing I'll say is that I obviously agree with Nick that it's very likely that that there's a very large portion of the reported volume that doesn't represent real trade.
What's your estimation? I mean, Chen, what's your estimation?
But the reason it's very difficult to know is because no one has access to the order books of everywhere, where, let's say, even if we just focus on Bitcoin, Bitcoin is traded. So, the Jewish Talmud says that prophecy has been given to the fools. I don't want to make unbased estimation. I can speak very well about the health of the volume in, some of the, places that we have visibility into trading. But I will say that there has been attempts. There are always reports coming out about, 95, 90, 70% of crypto trading volume being potentially manipulative. And one of the way, for example, that someone tried to assess that, Bitwise, which is a California-based, fund issuer, basically scraped websites, trading, the websites of exchanges, to see how many people, different accounts, kind of work, they essentially compared how many accounts actually are active, how many traders are actually active compared to what is the volume. And the result was that in many, many cases, it doesn't make sense. It's not possible that such, the amount of traders using those platforms generate that amount of volume. So that's one way, but bottom line, we will not be able to know for sure until there are increased standards of, surveillance of the volume. And of course, it's improving. The amounts of exchanges that deploy these systems in order to be able to assess what's real and what's not, and are more willing to report and be transparent about their policies, how they work with market makers, like you alluded to, Nick. It's constantly improving. It aligns with the fact that regulation is increasing. Regulators are concerned about this, of course, and they are concerned about it. I'll just answer the last question and stop there. But because it does affect investors, first of all, you often choose where you trade based on the amount of liquidity, and if the liquidity is not real, that's extremely misleading. Lower real liquidity is a big opener for potential market manipulation, because if the actual trading is very low, it's relatively easy to affect prices, compared to other places. So there's a ton of ramifications for investors, and that's even before talking about institutional investors, that for whom it's much more important when you're talking about larger amounts. I'll stop there, but generally agree. I just kind of wanted to emphasize a little bit, how some people try to understand it. But the bottom line is that as the system matures, a big part of what it's doing is putting in place these systems and becoming more committed to market integrity.
All right. So maybe, maybe Mike, can you also, with answering the question, can you also take the one from the chat? And one of our attendees is asking, how do you define the real liquidity? So we are right now trying to compare the fake volumes versus the real volumes, but how do you define that? That will also be helpful for us to define.
So I guess I'll go back to Nick's point first, and to Nick's point where he mentions that, there are many desks like us out there that don't report volume. We don't, right? We don't, there's no necessity from a business standpoint for us to ever share volume unless somebody knocks on our door and says, hey guys, you're being audited, what's your volume, right? We just, from a high level standpoint, we do, billions of dollars a week in spot volume and futures volume. And so that's not being reported anywhere unless, blockchains are being monitored and so on and so on, but that's more in Chen's world than mine, right? So to your question about real volume versus, fake volume, again, I'm gonna not give out any numbers here, and I'm gonna take the easy way out and go with the blocks numbers, because it's very hard to know what is real and what is fake. What we try to do as a firm is, trade on the most, and this is kind of what I was gonna say to anybody novice on this call. We try to, when we're doing any of our trades, we're trying to trade with the most reputable, or I don't want to say most regulated, let's leave most reputable, and exchanges that are on the way to getting properly regulated or are properly regulated as much as they can in their jurisdictions. So anybody, novice on this call, there, again, as Konstantin mentioned, there's over, 300 plus reputable, call it, exchanges out there where you can kind of go on and trade. But at this point, better to go out there and do your own research. There's a ton of reports, a ton of databases out there that share reputations of different exchanges. And then you could probably understand a little bit more if they're faking volume or not. Again, I apologize if I'm not answering the question directly, but it's very hard to predict what the actual numbers are.
Sorry, Konstantin, just to answer the question from the chat about real liquidity. I mean, obviously, when we say real liquidity, and I'd love to hear some of the more experienced traders in the room, agree or disagree with me. But look, at the end of the day, we're talking about people who are, trading fairly, meaning actually submitting orders with the goal of either buying or selling, not, playing around it in various ways in order to try and make gain that doesn't have to do purely with, the market. Now, obviously, it's from a legal perspective, I would even say from a philosophical perspective, there's some debate about what is actually market manipulation, because some people would argue that in a fully free market, if someone is smarter and can, maneuver his way to sell an asset for more money, then it could be potentially fair. But bottom line, there are very specific forms of behavior that are illegal. And the word wash trading came earlier. That speaks to essentially trading without the goal of actually, making any gain, meaning you end more or less, you buy and sell for the same prices, you end with the same, amount of assets that you had before, only in order to inflate volume. Why would someone do that? There are various reasons. Sometimes, let's say if you are initiate a new coin into the market, you want to show that people are trading it. So someone would literally, buy and sell between two accounts that on many of the reputable, 300 exchanges that we mentioned, you can open relatively easily, which is a great thing, right? Crypto is all about openness, but it also creates a reality where you can relatively easily create a few accounts, trade between them for the same price, just to show that there's trading and that there's volume in your asset. Also, a lot of exchanges, the way they make money is by showing that they have high volume, because that attracts coin issuers to issue their coins on that. So they also have an interest. And it's an interesting question you allude to, Michael, in terms of the actual requirement to report. And I do completely understand where you're coming from. But first of all, there are instances in the world where very, very egregious, manipulation of volumes has even resulted in jail time. In Korea, there is one case that happened a couple years ago. Obviously, that's from the exchange perspective, not the market maker, right? And I also think that I have a colleague, Alex Royals from Archex, who always speaks about the fact that regulatory unclarity is, obviously it's a challenge. It's frustrating sometimes when there's a gray zone and it's not clear what the rules are. But it's also critical for innovation, right? There's always some regulatory unclarity when you innovate and create something new. Regulatory unclarity is also an opportunity, sometimes to do what's right, in the sense that, and those exchanges, there are exchanges who share more information even though they don't have to. And again, I'm speaking of the exchanges, not in this case, not responding, to you, Mike. Obviously, it's a different story. And I would say that that's one thing that I do when I decide where to invest. I try to understand how transparent is an exchange.
How do you do that? Like, Nick, let's do some advice. Like, how do you do that? Like, how do you make sure this is not like fake? And once again, we had another question in chat, which was asking what the percentage of trades would be the wash trades. So we discussed it before and agreed overall that like almost 80% of all the reported volume may be counted as a wash trading. But you never know for sure, but that's the estimation of us. So Chen, how an institutional investor or someone who has doesn't have the institutional background, how can they make sure they pick up the right venue, the right place for their execution?
So we love to talk about transparency, decentralization, openness in crypto. And the truth is that crypto really is introducing those things and forcing traditional finance to think about those things. But, and for example, most exchanges do release, some data over API in terms of the trading, but, usually it's not enough data to really understand, whether there was manipulation. It doesn't include cancellations for for example, et cetera. I think that one thing to do is really understand what are the policies, how transparent is an exchange, and then also go back to some of the benchmarks that benchmarking reports that that Nick mentioned earlier. For example, Crypto Compare, which are partners of ours, release a semi-annual volume credibility report where they do a combination of things. They also cannot know, and I'm kind of alluding to the question in the chat, what exactly is the percentage of trades that are, affected by wash trading, because no one has access to entire order books of the entire ecosystem. But they do have access to large amounts of data. Exchanges collaborate with them because it's important to those exchanges to be ranked higher in terms of their volume credibility. So they share more data with them, and they also survey for their compliance program. How big is their compliance program? Do they use an externally provided market surveillance solution? Are they regulated, and where? Because, where you're regulated is often very related to, the policies that you have. So, the quick answer is, first of all, do your due diligence. There's no magic. You have to work hard in order to do well in this space, like in any other space. And how to do your due diligence? Look into the exchange's policies, read about it, and specifically look for third-party provided reports on those policies. Because obviously, when someone reports on itself, it can be, it can be honest, but it can also not be. Yeah, so I'll stop here. But those are three things that I think are very important to do when deciding where to spend your money, where to invest your money.
All right. So we've talked a lot about the the liquidity, but let's then switch to the topic of the trading venues. So for all the attendees that are now right now with us, what are the trading venues for an institutional investor, or let's say for a payment service that doesn't have a background but still has some like retail flow that they need to change, some fiat to crypto or crypto operations. So for those guys, what are the execution options are there in the market? And if you can compare them and like list some pros and cons for that, that would be very helpful. So Nick, can you elaborate on that?
Yeah, no problem. So I think that there's a lot of different methods to buy and sell cryptocurrency in the market. And I think we already spoke quite a bit about the exchanges. That's probably the most common way people come into the space. There's also places like a Blockfills, which is essentially an electronic aggregation provider of liquidity, which is a hybrid of an OTC desk. There's what's called OTC desks, which in the traditional markets would really just be similar to a broker dealer or an interdealer broker. There's also payment providers. So there's many payment providers similar to PayPal coming into the space that are offering, the possibility to buy and sell crypto. There are software providers like a Finery Tech, where you can go to and purchase their software and use those types of services as an internet service provider to buy and sell through their preferred counterparty. So I would say, and of course, traditional stock brokerages, some of the FX brokers are offering it now. So it's becoming more and more mainstream. And those are probably the main ones that would come to my mind.
All right, thanks. And Mike, can you maybe talk a little bit about the pros and cons for that, like for all the options here?
Yeah, so I agree with. I don't know if I have much to expand on Nick's point there. I think you covered it pretty well. But for crypto businesses or large scale traders, I think they would probably position themselves to work with either an institutional OTC desk like DV Chain, or a venue like Blockfills that is aggregating a bunch of exchanges and can execute on best price. And so there's. I'll do a high level of advantages versus disadvantages on exchanges versus OTC desks. There's probably less, between Nick and myself, for example. So, an over-the-counter desk, essentially, you're dealing with, one counterparty. You have the ability to do large block size trades, and you don't have any market slippage. So if you're either an institutional investor doing a trade or allocating to your treasury, whatever that looks like, there's no actual market slippage, essentially, because you're able to execute on point at the best price on market and be able to lock in that price. And so with exchanges, you're not sure how the market's going to react, and you could be sitting on an order, if it's a large order, for hours trying to execute. And essentially that could cost you a lot more than you would pay, let's say, through a vendor like Blockfills or us, DV Chain. That would be kind of the first example there. The second example really of, using an OTC desk versus, let's say, an exchange is the underlying transactional costs. So essentially, you go on an exchange, you pay money to deposit, you pay money to withdraw, you pay money to switch over between tokens. With an OTC desk or a vendor like Blockfills, everything is an all-in spread. And again, that essentially the underlying transactional cost will essentially make the trade much cheaper for whichever institutional trader is able to execute on it. And just to add on it, venues like Nick, like Blockfills, like DV Chain, we have APIs, REST API, Fixed API, WebSocket, where any one of these crypto businesses that need to convert from crypto to cash all day long we're able to execute it for them all day long without any market slippage. So what that means is if your business is taking in crypto, but you have no idea how to trade it, you don't want to go to the market to trade it, you connect to our API, we're able to execute those prices for you right away, and you don't have to worry about that. You just worry about taking in the crypto, and we give you the cash.
Right. So like we're all working in the capital markets, and in the end of the day, it's all about the margin actually. So trading with an OTC desk can provide an institutional investor or a crypto related business just some price improvement associated with costs, right? With better flexibility and like the execution price improvement.
Exactly.
Just to sum it up.
Exactly. Yeah, go ahead.
Go ahead, Michael. Go ahead.
No, I've talked too much. Go ahead.
I was just going to say I agree with all of his points 100%. And, I think that this is why we're probably, both in the spaces to really service the business component of the crypto industry. And, just to add a couple of other, I would say, advantages or pros and cons. And we didn't really talk about much of the pros of exchanges. There are some, but, of course, credit's a component in this market. So when you're dealing with an OTC provider like a DV Chain or a Blockfills, oftentimes you do get pre-trade credit, meaning that you can transact and settle up throughout the day as your position grows up to a certain extent. And that just makes things a lot more efficient with sending money in and out. Especially if you're dealing with an exchange, which, if you know anything about exchanges, it's very, very difficult to get money in and out of, or crypto in and out quickly when you're dealing with an exchange, especially when the markets are moving around. So, it's another huge advantage of dealing with an OTC provider.
And to that example, we had a lot of backlogs even this week in certain chains, right? So if somebody's trying to send to an exchange and they're stuck and their block's not being confirmed, well, whatever it is, the arbitrage opportunity, the buying opportunity, the selling opportunity, doesn't matter, it's gone. So with Blockfills or DV Chain venues like us, you're able to actually lock in that price before, which Nick mentioned. We settle on post-trade settlement basis and essentially alleviates any institutional investor of that risk.
All right.
Yeah,
so,
and I think the last point I would make on that, it also becomes, and that leads into sort of the customer support component. And I don't want to sit here and bash exchanges and say that their support is bad or anything. But we groups like a DV or a Blockfills, we provide much more high touch support because we have such a smaller client base dealing with institutions. So you're going to be able to come to somebody and say, look, I need to, I need to settle now or whatever you need to do. I need help with the platform. You need help with the API. And so you get a little bit more of a high touch experience than you would on an exchange where you're oftentimes just dealing with the website unless you're
the basic tickets, right?
Unless you're a VIP client or something. Yeah.
All right.
I wonder, I actually have a question and I'm curious for your opinion, and I'm sorry if it's a bit of a rudimentary question, but would you guys agree, would you say that, perhaps, as from an individual retail investor perspective, without a lot of experience, it might make more sense to go with an exchange versus an OTC, or would you disagree with that? Versus an institutional / someone who has more experience?
I would agree wholeheartedly with that. I think if you're a retail investor that's just starting out, an exchange is probably a better place to learn and get your feet wet. And also they have typically a much broader product range on the crypto side. They're going to have hundreds of coins, whereas we might have 40 or 50 that we trade, and at the most and probably 10 that we trade a lot. So it's like, and from that perspective, it gives them a much wider array of product for sure as well.
All right, just so Chen, I think
just to add one thing there, Konstantin, I apologize. So for OTC desks, and Nick, I'm not sure about Blockfills. I assume it's the same, but we have minimums, right? So we don't allow any individual retail client to walk in off the street to trade with us. We have certain minimums on, stable coins. We have certain minimums on everything else that we allow. We don't take on any retail clients, but if we do, we have certain minimums. So I would say that from a completely novice perspective, it would be probably 100% better to go to an exchange. And then, back to our point that we spoke about earlier, if anybody wants to test out, unfortunately, there's no other way to do it, but, put a $10,000 trade on an exchange and see how quickly it gets filled and what the order book looks like when you do that, right? There's no other real way to do it, because if you're not getting filled, there's no liquidity. If you're getting filled at way wider spreads, there's no liquidity, right? But other than that, it's very hard. I would say to Chen's point, go online, check the resources, but without doing it yourself, it's very hard to understand what liquidity sometimes looks like.
Yeah, makes total sense.
All right, yeah. So just once again, for wrapping it up, if you have less experience, if you're more looking for a private execution operation, you should better choose a centralized exchange. But for those institutional investors and the crypto-related businesses looking for bigger volumes and the bigger executions, that's definitely an option to pick up, to go to a liquidity provider or OTC desk. So we are glad that your guys are onboarding with us, and like all the clients and crypto-related businesses could get access to DVChain and Blockfills via Finery markets. So we can move on to the next point, and let's talk a little bit about the bad behaviors in the market. And I think this is one of the most interesting topics. So we've slightly touched like the wash trading, which just creates dilutes some of the investors. But let's talk about like what exact bad behaviors or fraudulent behaviors are there in the market, and how do they affect the end clients? So can you talk a little bit about that?
Yeah, of course. So I mean, we touched about it earlier, but at the end of the day, the highest level definition of market manipulation specifically is trying to affect artificially, and usually through some degree of deceit, the price or volume of an asset. Obviously, there are other forms of bad behavior. I mean, like hacking, forms of fraud where someone would, oversell, promise a lot when you invest in a specific coin and it would all be completely made up. I'm currently focusing on market manipulation, which is really using the market to trade in ways that are, manipulative. The way we think about it, when it comes to crypto market manipulation, there are the known knowns, the known unknowns, and the unknown unknowns. The known knowns are essentially forms of manipulation that we know from traditional markets that take place quite similarly in crypto markets. And that would be, for example, wash trading. Pump and dump is another example. Usually that would involve some, external way of pumping, of hyping an asset, getting people to invest in it, and then selling in order to make money off of that. Spoofing, which is using essentially orders in order to create the same effect, more or less. Layering, which is a flavor of spoofing. There are a lot of different kinds. They happen, as you can imagine, they happen in crypto markets very similarly as they do in traditional markets, and they happen more because there are less, there's less regulation, there's less supervision, and it's more open. So there are more people who are not necessarily savvy traders. What's also interesting is what we call the known unknowns. And those are forms of manipulation we know from traditional markets that can also take place very differently in crypto markets, meaning take advantage of the structure of the market, the new forms of data, and do it differently. So for example, when it comes to wash trading, we see a lot of what we call circular wash trading and cross-market wash trading. So circular wash trading, because it's very easy, there are a lot of different assets. When you go on an exchange, many of them are of course, Michael mentioned earlier, altcoins. You can easily, if you want to inflate the volume, take one asset, trade it for another, trade it back for the same price, trade it for another, trade it for the, and then do it sometimes, dozens of times, making it very hard to detect. Cross-market manipulation, and I'm sorry for talking for so long, I'll start wrapping up quickly, but takes advantage of the fragmented, decentralized way the market works. If you think about it for a second, Bitcoin and digital assets are perhaps one of the only non-physical assets that are not native to a single exchange. If you invest in an Apple stock, it's a stock that's the original stock is traded on NYSE. but Bitcoin is, traded on a million different places at the same time. No one has, full ability to trade all of it. And for example, when the Securities and Exchange Commission is rejecting Bitcoin ETFs, they say, we just can't know that it's not being manipulated somewhere else, and will trickle and affect our investors through, the ETF. Very quickly, just the unknown unknowns, and I'm happy to elaborate on that. That's, really where we're starting to very, very much focus. That's about, DeFi manipulation, things like block level front running, Oracle manipulation, smart contract manipulation, and just, and also in centralized crypto markets, really new things that we constantly discover and typologize that are specific for this market. I'll just stop here, but I'm happy to elaborate on all of those at any, later.
So maybe I'll then address the question to Mike. So how do you actually, work with these behaviors? I mean, how do you manage them themselves when, you're trading on the centralized venues? That's first. And the second, which is, I think, the most important question, is that, like you do actually provide the pricing to the clients, which is cleared off from all these sort of behaviors, right? Because these may happen on the centralized exchanges, but when you faced some liquidity provider you trust, this is like not something that you may see as a client and you may face as a client. So is that correct? And maybe can you talk a little bit about that?
So if I'm understanding the last part of your question there, Konstantin, you're asking if wash trading is happening on a venue, and we're essentially trading with that venue, how do we react to that?
Yeah, that's first. And the second one, facing the, like I would restructure it in a different way. So the question is, when the client trading on the centralized exchange versus, the OTC desk. So those behaviors, where can the client see them? So is that on the centralized exchange, or can they face something like that when trading with an OTC desk?
Yeah, so I guess to regards to the first question that you asked there, when we're, so, from a KYC AML regulated perspective, we run that on every single counterparty that we trade with. We never face off. So if we're, let's say, providing market making services or liquidity provision services to an exchange or an RFQ type Bitcoin service, whatever that looks like, we are trading with that one counterparty. We are not trading with anybody who's trading on their venue. And essentially, when we do all our KYC AML regulatory checks on them, we ensure that they have proper AML policies, and they essentially give up the legal right to say that, hey, we're making sure that everything is, A-okay on our venue, and you're facing off against us from a legal standpoint. So really that, we can't control what happens on every single venue. That's really out of our control. If there's ever any red flags that come up, we'll probably stop working with them if that's the case. But it's never really happened before where we've had to bring that up, to be honest. And then with regards to OTC desks versus exchanges and wash trading, I think it's a little bit more difficult to do with OTC desks. As Nick mentioned, businesses like ours have way less clients. Like you look around the landscape of crypto exchanges out there, there's exchanges with 500,000, 1 million, 5 million, 10 million, 50 million users, right? We're not in that business, right? We have maybe a few hundred clients each. Nick maybe has a few thousand, I don't know. But regardless, it's a lot easier for us to monitor whatever flow is coming through us than it is for exchanges to do so. So for example, flow that we don't like is toxic flow, right? And that's a little bit different than wash trading, but it's essentially traders who might have really amazing strategies. Let's give them the benefit of the doubt, or they're using our prices to arb and hedge against other venues, right? And once we start noticing that, and if we're taking losses on those trades, because we don't have hundreds of thousands of clients, we can essentially just shut down trading for that client if that's need be. But essentially for us, we're able to monitor it a lot closely if that were to occur on our venues.
All right. So Nick, anything to add here in the comparison of the centralized the OTC desks?
No, I think Mike did a great job there. I would, I think, from a toxic flow standpoint, we see very little of it on our venue. I think, traditionally where you would see the toxic flow is from, typically, very algo driven sort of robots that come in really small amounts and, for lack of a better description, surprise you somehow. Or it's a really, really sophisticated algorithm that's is like Michael said, making a lot of money. I mean, in our model, it doesn't so much matter because we don't really trade on a principal basis. We're an agent. Our business is an agency model, but where it does affect us is if we were to not monitor that type of trading, it would affect counterparties such as Michael. And we have many counterparties that are not exchange liquidity providers. And then, if we start sending them flow that they don't want, obviously they're not going to want to trade with us each and every day. So, but we've really seen very little of that over the last 3 years, and it's almost shocking how little we've seen.
So oh, sorry, I didn't mean to interrupt you, to cut you off.
No, I was pretty much done. I mean, I have to imagine, the exchanges have a lot more of that flow, obviously.
So look, I think something that's very important to say is just how much the crypto market matured. And part of that is people as experienced as you guys coming in and offering, services that are much more, advanced and sophisticated. One thing that I can say, and again, no one can speak for the entire market, right? Those are usually, at best educated, educated guesses or, based on some good research, but no one has access to all of the order books. But compared to, this bull run, compared to the 2017 bull run, in 2017, we would see a lot of what we call wholesale market manipulation. That is the massive kinds of wash trading, kind of shameless, blatant pump and dumps. All of that was kind of also affiliated with the ICO boom. And we now know that, according to regulators, 60-70% of ICOs were potentially fraudulent. So it all kind of came together. There was a lot of buzz, a gold rush, which is when people feel like they have to invest, otherwise they'll miss on something big, and a lot of opportunity to take advantage of that, and very little guardrails and checks and balances. That is no longer the case in 2020. I mean, not to say that these behaviors, in some exchanges, don't exist, but in places where we have visibility into, we see, just like you were saying, Nick, much less of those behaviors. What we do see are other forms of more sophisticated, market manipulation that is much, kind of harder to detect without specialized systems. And I was kind of alluding to some of those earlier when I mentioned the cross-market wash trading and circular wash trading as examples. Obviously, there's a longer list, but it is important to say that since 2017, the industry really matured. Part of it has to do with regulators coming into the space. Part of it has to do with institutional investors coming into the space and expecting higher standards because they're putting much more, skin in the game in terms of how much they invest. And you're seeing a gradual improvement in all of those capacities. So it's important to say it's natural for a younger market to have these behaviors in it. It's also really important to say what you said earlier, to emphasize what you said earlier, Konstantin. Market manipulation is not something that's special to crypto. JP Morgan was fined almost $1 billion in October for, an instance of swaps manipulation in some of its services. Younger markets are more exposed to it because of all of the things that I mentioned. But and they're also, it makes sense that younger markets would be more scrutinized. We have more to prove, which is all the more shows how important it is that experienced traders who understand markets are increasingly offering services in the space. And we're, without a question, moving into a very good direction, to a much better place.
Right, guys. So I think we should have a last round of questions, and that would be like the two basically. So I would like for each of you to give your thoughts on what are the future of the the execution venues. So what are the key trends there that will be happening in the last 3 to 5 years, So what we will see across the competition? Do you see the market will consolidate or like something like that? So that's first. And the second one, what's your advice to the crypto-related business or an institutional investor who is looking for a crypto venue? So maybe Chen, maybe we can start with you and then pass the word to Nick and Mike.
I always like to go last, but sure. So look, I think I spoke a little bit just a moment ago in terms of where I think the market is going. I think that, look, I mean, we started a crypto market surveillance company in 2017, 2018. At the time, we would go sometimes to even very institutional oriented, you know, like there were a lot of talk about security tokens. So to even very institutional oriented events, and we would say crypto market surveillance, and people would raise their eyebrows. They didn't even understand, you know, how is it related? You know, it's, you know, the CEO of Kraken, sorry, his name evades me, Jesse, never mind, the CEO of Kraken, one of the most important, Jesse Powell, sorry, one of the most important exchanges in the world in mid-2018 said, crypto traders don't care or want to be protected from market manipulation. You know, he's a very smart guy. He said it on purpose, I'm sure, but you know, you know, that's not, you know, it's clear today that it's not true. You hear executives at places like Binance, which is not oriented towards regulation, saying it's extremely important to have market surveillance, and the exchanges that take it seriously are the ones who are going to be able to grow and attract institutional volume. So the market is going in, you know, is constantly improving, and I think that the real competition between you know, trading platforms, specifically exchanges, is going to be how well they can respond to regulation, how well they can make investors confident, and look, there's a whole other piece here, and that's talking about DeFi. I'm not going to get to it right now, but that's, you know, there's a lot of thinking to do there in terms of market integrity and regulation. But
so we'll all need to hire lots of compliance officers. I think that will be one of the most training job offers.
Or you need to, you know,
I'll flip that and say that DeFi platforms need to hire a lot of compliance.
Right. No, I'll say, or, you know, again, I don't want to, don't want to oversell too much, but part of the way to hire less, compliance officers is to have the right systems in place that can really help streamline this process. And of course, that's what Solidus Labs is trying to do. So if you want to hire, less compliance officers, or, you're welcome to get in touch.
All right. Great. So then maybe Nick, like some words about the trends and like what's your advice for an institutional investor out there?
Yeah. Well, I think for the trends, and you touched on this earlier, I think for the retail side of it, and the exchanges, I think you will see consolidation. I don't know how, I don't know the number of exchanges that exist now, but of course, I think the, the top 25, 30 in the next couple of years, I think will really emerge and have a foothold there. I think on the institutional side and congruently, sort of talking about that, a lot of the exchanges are really trying to make a play to the institutions, and thus far, I don't think it's worked extremely well. And I do think that the future of it is you're going to see them to continue to try to get better technology, custody solutions, APIs that are, and maybe even support that are better served for institutions. I think at this stage, you're probably as an institution much better trading trading with somebody like a DV Chain, a Blockfills, where you're going to get sort of that better pricing, higher touch service, lightning fast APIs, all that good stuff. I think you're going to continue to see custody evolve and continue to get less expensive. For the institutional clients, you're going to see banks coming into the space. We're already seeing it. I think it's definitely going a bit more mainstream in that perspective. And I remember 2 years ago, I looked at some of these custody providers and they're charging, 20, 25 basis points a transaction. And I was just kind of thinking to myself, I'm like, well, that's pricing them out of the industry. I don't know how that's going to work, but I don't know what institution would pay that. And now you're seeing, somewhere between 1 and 5 basis points, different models coming out. So, that's been really interesting to watch. But, I think custody is really important for most institutions, or, having some sort of centralized wallet system that that they use internally. And we're seeing, we're going to start seeing some banks come into it, but these places still need pricing and, technology. And I think that's where groups like Blockfills and DV will continue to evolve.
All right, great. So, Mike, what are your thoughts?
I think Chen and Nick already covered quite a bit of it, but I guess I'll add that what we, over the last few years, the fragmented markets have become aggregated through venues like Blockfills, through venues like ours. And that's really where, we've seen a lot of the trends going, right? Institutional investors want to essentially, from a price discovery standpoint, or even be able to execute on best executionable price, they want to be able to have because of how many venues there are actually out there, they want to be able to execute in one place and see the best price between all the venues, right? So just on that standpoint, I think you've already seen kind of a huge trend move that way. And I know Nick could probably vouch for this, but Blockfills is their volumes have soared, right? Because of this, they were maybe ahead of the game a few years ago, but in the last 12 to 18 months, I would assume, being one of the leaders in the space, the volumes would have soared. And so to that point, right, that's where we're seeing that side going. We're also, I think, eventually going to see a ton of M&A in this space. There isn't a lot of traditional exchanges that have really gotten into providing crypto directly yet. They might be doing some things in like behind the scenes, but not to the public eye. And so I think that'll be the next step. And at that point, right, if you're an institutional investor, or even a retail investor, are you going to, let's use the biggest exchange in the world, are you going to Binance, or are you going to the New York Stock Exchange to buy your Bitcoin, right? And so we'll probably see what comes out of that.
All right.
Yeah, good points, Michael. And I'm just going to add one thing to that. I know we're getting short on time. I think just from a counterparty risk perspective, what we're seeing from institutions is really, they might want a handful of counterparties, and they want them, or they have some sort of mandate where they need to be in a certain geographic area, or have to have certain product depth outside of just the spot market. So maybe that's futures, maybe it's options, maybe it's whatever it is, structured products. But I think we're seeing definitely starting to see more demand and more exotic products. And also, there's that counterparty risk component, and not to say, Blockfills has the greatest balance sheet, across the world, but it's more so just a number of counterparties and maybe where those counterparties are, and they just want a few of them. They don't want to be on 20 exchanges.
All right, so that's makes total sense. And I think we're already running out of time a little bit, so I would like to thank all the attendees for listening to us, and hope that will be that was helpful. And Chen, Nick, Michael, thanks a lot for having that discussion. That was really interesting. So just for wrapping it up, I think from what we've discussed is that there are lots of still there are lots of bad behaviors in the market, which I hope like in 5 years we'll see the regulators will help us beat that. But as of now, please do your research. Also use third-party providers for that. And if you are an institutional investor or a crypto-related business, it just makes more sense to trade with the OTC desk and with liquidity providers. And like there are all the options out there, and DVChain and Blockfills are one of the greatest options here. So you can use Finery markets to connect to all the guys, and enjoy all the great services which Mike and Nick just mentioned. So hope that will be helpful, and I wish you all guys a safe safe ride in the crypto market space. And thank you all. Have a great day.
Very much.
Bye bye.
Thanks, everyone.